to sign my waiver of liability because I know we're being recorded right now, so hello everybody. Once again, my name is Tony Watson. If you don't know who I am, I'm the tax guy. I see a couple familiar faces in the audience. I've spoken, like she had said, at many places. We do close to, I think, 175 seminars a year. Yesterday I was in South End Regional Association of Realtors, and I was in Beverly Hills late last night doing a high-end real estate networking club and speaking a little bit there. It's tax season, so that's why I'm here. Hopefully everybody has either contacted their accountant to set up their tax appointment or is thinking about calling their accountant in the next few days to make sure that you get in before either April 15th or at least file an extension. A couple of really exciting things moving forward into 2015 that I've seen so far all deal with the real estate industry. I mean, my real estate clients, they're happier than ever. They're out there, they're hitting the ground in 2015, running full force. I had a lot of clients last year who said 2014 was a great year. I had a client in my office the other day who's already closed 6 transactions, and it's January 27th in 2015. So I hope that is the trend for this year, and I wish you all nothing but luck and prosperity. So to start off with, we're going to talk about maximizing your deductions while minimizing your liability. We're going to touch on a few write-offs that you need to focus on for 2015, as well as specifics for the real estate industry as real estate professionals. A lot of things that I talk about are real estate related, but I'm also going to focus on things that are special elections for any individual who is a self-employed individual, whether you own a small business, either in the real estate industry or product and service business, maybe you own an antique store locally here in the San Gabriel Valley. Anything across the board as far as self-employed tax preparation is concerned, we're going to focus on that as well today. So just a quick picture of our building. If you don't know who we are, I don't know if she mentioned that we've been around since 1971, so we've been around for quite some time. Bob Hall, it was a principal of an elementary school back in the 70s, early 70s, I think 1970, and he realized that he could make a whole lot more money preparing taxes and helping his clients and his fellow teachers and associates out with their taxes. So, 43 years later, we service just shy of about 10,000 filings per year. And I'd say that 60 to 70% of my personal clientele are real estate professionals, so I put a little bit of a twist on my topics or on my seminars because I'm focused mainly on real estate, so hopefully you have some sheets of paper that you can take some notes on. We do tax structuring for investors, agents, brokers, and developers and property managers, so we do focus within this industry, and we help our clients with tax preparation, tax structuring, audits, and incorporating services. So enough about us. Top 5 tax deductions that you're going to focus on this year for real estate agents or real estate professionals in general, whether you're a property flipper, a long-term holder, or just a real estate commission-based self-employed individual. We're going to talk about these 5 deductions, and if you've already heard me talk about these 5 deductions, they haven't changed, by the way. So you're going to want to focus on these this year even more than last year. Hopefully, you got back money or you broke even last year. Hopefully, you didn't have to cut big fat checks to the IRS. And if you did, you're probably very happy because you probably made a lot of money. And you didn't have enough time to plan to pay Uncle Sam all of his money because you were too busy making money. So, the first deduction we're going to focus on happens to be mileage. I always make this joke. I mean, how many people ride their bike to work? My point is made. Okay, so everybody is going to have this mileage deduction. Now, the deductible amount per business mile fluctuates from year to year. Okay, and so it changes. It's not always going to be the same. In fact, 3 years ago it was averaging between 50 cents per business mile and 53 cents per mile, and it changed halfway through the year. Right now it's about 56 cents per business mile. That means that if you have 20,000 miles that you put on your car last year, and let's say that 10,000 is for business use, let's say that 50% of your mileage is business, you get a $5,600 write-off just for having 10,000 business miles deducted on your business tax return. That's a pretty substantial write-off. Now, between the two individuals, one who owns a V10 Excursion that gets like 5 miles to the gallon, right? You're probably wanting to make a calculation. Is it going to be more beneficial for me to take the fuel write-off or the mileage write-off? At that point, because you have such a large vehicle, it can be considered a specialty vehicle in your industry because you have to move things around, heavy equipment or signage, things like that. So you might be able to take the fuel deduction, which will be greater more likely than not than the actual mileage write-off. However, if you are the person in the room who drives a hybrid, right, where you fill up for the full year, you spend maybe $4,000 on gas, right, and it gets you, 80 miles to the gallon. If you're electric, that's even better, but if you have that hybrid, you're not paying very much for gas, so you definitely want to take the deduction for business mile, not the actual fuel write-off. Now, one thing, just a little note to you, if you are taking the fuel deduction on your tax return as a line item, meaning that you're actually writing fuel as a line item, part of your return, and then putting a dollar amount, what you are telling the government is that you have a specialty vehicle of some sort. You know, either a Gulfstream jet, or a helicopter, or a bus, or a dump truck or something, because fuel technically is not deductible as fuel. You want to put it as auto and truck expenses, not fuel, because essentially you're telling the government that you have a specialty vehicle that you need to operate with your business. So you either want to put it in the auto and truck expense column, or you want to source it as business mileage deduction. The mileage log is very, very important, especially if you are ever questioned by the IRS. The Internal Revenue Service isn't going to call your bluff on mileage. All they're going to ask for is a mileage log. If you show up to an audit and you say that you put 30,000 miles on your car and 29,000 of the 30,000 miles was for business use, is that reasonable?
Nope.
No. It's not a reasonable amount to say 29,000 of your 30,000 miles was for business use. So the IRS actually looks for four very important things in every write-off. For the deduction to be ordinary, necessary, legitimate, and above and beyond reasonable. Okay? Even though mileage is an ordinary deduction, it's a necessary deduction, and it is quite legitimate, it has to be reasonable. And so when you source business versus personal mileage, and that includes commuting, which is not tax deductible, you need to be careful that you're taking or not taking an aggressive ratio. All right? Now the mileage log proves what is business, what is personal. And so in an audit, the government will expect you to have that mileage log. If you are questioned and you don't have a mileage log, they give you 3 to 4 weeks, anywhere upwards of 2 to 3 months to put this information together. So do not sit on it. Don't tell your tax preparer that you just don't have time to put it together. You could be losing out on a very sizable deduction. And the government is not giving you industry averages anymore. Whereas 3 or 4 years ago, we'd walk into an audit and we'd say, okay, we have a real estate professional here. Industry average based on their income is like 5,000 deductible business miles. And they give you an average and you wouldn't have to do anything, right? Because you were happy with just getting that as a deduction. You didn't want to have to do any work. They're not doing that anymore, okay? They are expecting every taxpayer to have their mileage log. So be very careful. Make sure that if you have some time to put it together, you sit down for an hour or two any day of the week, put together however many destinations you drove to, any properties that you listed. I guarantee that you're probably undershooting your mileage as a deduction if you're not actually tracking it on a weekly or monthly basis, all right? So be careful. It's a great write-off. Number 2 would be legal and professional services. Anytime you pay an accountant to file your tax return, financial planner to set up a 401k, the sheriff's department to evict one of your tenants if you own rental property, these deductions are dollar for dollar tax deductible. Do not limit them. Do not say that, oh, okay, well 50% was because I just needed some legal help and the other 50% was for evicting my client. Take it dollar for dollar against either your Schedule C self-employed income. If you're incorporated, take it dollar for dollar on your corporation, or if you own rental property, take it dollar for dollar on your Schedule E, which is the rental property form. Do not limit it. Don't depreciate it. Don't amortize it. Don't capitalize it. Take it as a dollar for dollar write-off. Travel. I'm not going to spend too much time on this today because we can talk about this for the next 4 hours about how to write off your Hawaiian vacation as a business deduction. But we're not going to focus too much on that today because I want to get on to some more important things. Travel is a great write-off. Let's face it, that most of the time when we travel to places like Hawaii, it's for personal use, right? But in real estate, you have a really, really great opportunity to make the argument that a portion of anything that you do is a potential tax write-off. Because what is something that you can go anywhere and do in this world? You can sell real estate. When you go to Hawaii, are there properties on Hawaii, on the island of Maui, on the main island, Big Island? Yes, there's property there. And so the government expects you, if you are going to take a portion of your travel, they're going to expect you to have some sort of paper trail. You know, before you go on the trip, shoot an email to a real estate agent on the island of Maui and say, hey, listen, I'm a California real estate agent. I have a couple clients here who are looking to buy property in Hawaii or abroad. It doesn't matter where it is. So why don't you send me a couple listings that you have, and I can forward that to my client. And then when you're there in Maui and you're driving your rental car along the coast of Maui and you're enjoying the sunset and you drive past all of these properties, you see a couple for sale, pull off, spend a few seconds, grab a flyer out of the little box at the front on the front lawn. Stuff it in your luggage. That creates legitimacy in the write-off, okay? I'm not going to say that 100% of your vacation is a write-off, all right? That's not what I'm up here telling you, all right? But yeah, or selfies, right? You just take a selfie in front of the house with this for sale sign. But you have to create an intent. You have to create a legitimacy to the write-off if you are going to take a certain percentage of that. And then your question to me is, okay, well, what's a good percentage to take? I really don't want to give you a percentage. Just make sure that your accountant is looking into that for you, is giving you that kind of advice, because, $1,000 here, $500 there, $1,200 there, added up over the course of 365 days. As a self-employed individual, every dollar that you write off is going to save you from paying 3 types of taxes: federal, state, and then the lovely self-employment tax that you all pay, all right, which is 15.3%. So focus on gathering as many deductions as possible, because I'd rather have the money in your pocket throughout the year so you can reinvest into your own real estate investments or defer it into your own retirement rather than paying Uncle Sam or overpaying Uncle Sam. Meals and entertainment. Let's face it, we live in probably the entertainment capital of the world, right? We live in Los Angeles. People think if they don't live here in California and they've never been to LA, they think we're all Hollywood, all right? So why not feed into the stereotype? Take the meals and entertainment deduction. Don't limit it. I mean, it's going to be 50% deductible anyway. Meals and entertainment is always 50% limited. All right? But the government does look at different geographical areas in the U.S. and they compare meals and entertainment to other parts of the U.S. For instance, if I'm a real estate agent in Arkansas, do you think that I'm going to have as much meals and entertainment as you folks here in Southern California? No. Absolutely not. Cost of living is much less. And you're probably not doing as much entertaining, going out to nice steak dinners and buying fancy bottles of wine and making sure that the deal closes and developing that trust relationship with your client or potential client. So make sure that you take this. Don't let your accountant sit there and tell you that he thinks it's an audit risk, okay? I'm not saying that if you make $100,000, you should write off $50,000 in meals and entertainment, okay? Remember, the deduction has to be ordinary, necessary, legitimate, and above and beyond reasonable. But do not be afraid to take this. It might run a little bit higher risk of audit, but this is something that's a line item deduction. And so when the IRS decides to question this write-off, it's a line item audit. They pull one deduction off your return, you verify it with a list of people who you entertained, the business that was discussed, and making sure that you limit it to 50% as a write-off, and you're good to go. It should only take 15, 20 minutes of arguing with this IRS agent about why this is an ordinary, necessary, legitimate, and above and beyond reasonable write-off. So make sure that you take it as a deduction. Change to yellow. Nice. Oh, there we go. So advertising, product development, marketing, radio, television ads. These are great tax write-offs for the self-employed because, once again, just like meals and entertainment and travel and mileage and all that stuff, this is how you build your business. I mean, sure, we could all be as lucky as Mark Zuckerberg, where you don't really have to do much. You create an idea and you make $65 billion or whatever he's worth nowadays. You could be Steve Jobs. You take LSD and you invent the iPhone, right? I mean, we're not all like that. So you have to make sure that you're advertising. Referrals are great. Obviously, your business will build based on referrals. Those are the strongest leads. But at the end of the day, you need to get your name out there. You need to get the name of your business out there because people won't know who you are. I know just driving through San Gabriel who George Realty is. I see the sign on every single person's front lawn, man. I see that name everywhere. I see my clients' names posted all over Glendale, posted all over La Cañada. I see that as I'm driving, and I'm a tax accountant. But if I'm looking for a piece of real estate and I see that sign and that name, I mean, I don't even have to look at the sign. I know his name, right? I might look online and just type in George Realty. I might find him and say, hey, listen, you seem to be a pretty successful realtor in that area. I see your signs all over the place. Do marketing, do product development, do advertising. Because people like me who aren't in the real estate industry, we notice those things, believe it or not, okay? So make sure that you're doing that. Dollar for dollar tax deductions as well. This will not only earn you more revenue, but it'll save you from paying Uncle Sam exponential amounts of tax. So why not get the best of both worlds? All right, so we're going to talk about the most audited real estate tax deduction for a second. You know, if you've heard me speak before, you obviously know the answer, but we're going to go over it one more time. All right, the in-home office is a great write-off. But let's face it, the in-home office deduction, if you are not incorporated, if you're just a sole proprietor, this form alone, just this form on your individual tax return has close to between a 65 and 70% chance of audit. All right? It's called the in-home office deduction form. It actually takes the percentage of square footage within your house that's an office versus the total square footage, and then you get to write that percentage off of your mortgage interest, your property taxes, your HOA dues, your homeowner's insurance, and it offsets your self-employed income. But it has close to a 65 to 70% chance of audit. Now, I'm not going to ask how many people in the room are incorporated, but just understand one thing about being self-employed and being a sole proprietor. you have no options as far as paying yourself a reasonable salary, paying less in self-employment tax, and you probably file some of the most highly audited forms on an individual tax return, the in-home office form and the Schedule C. They actually have a special division at the IRS that focuses mainly on these two forms. It's called the Small Business Audit Division. It's based out of Sherman Oaks. All right, and we go there and argue with those people all the time. And a lot of the times it's a no change, thank goodness, but at the end of the day, it's time spent out of our day, okay? And so as a self-employed individual, you have a very, very prime opportunity to incorporate yourself as an S-Corp, depending on if you meet certain requirements, and not only save yourself exponential amounts of tax, but significantly reduce the potential for audit, especially on this particular write-off. Because as a corporation, you are no longer self-employed. You're an employee of your own corporation. Right? So you work for your own corporation, and so the corporation doesn't file an in-home office form. The corporation actually pays you to rent out the office inside of your house. So you're no longer filing this 8839 form or 8879 form, you're filing the Schedule E, which is a rental property. And that has less than like a 10% chance of audit. So not only do you get the benefits of adjusting your rent on a year-to-year basis, taking the deduction, converting self-employed income into rental income, which isn't subject to self-employment tax now, but you're also decreasing your potential of audit while you're doing all of this. It's a beautiful thing. I get excited talking about it, and I know that you guys don't care. But you need to talk to your accountant about all of these benefits of incorporating and if it's right for you, all right? So the in-home office deduction, it's not the #1 audited deduction on a return, but it does have a very high audit risk. Meals and entertainment, I threw this up here again because meals and entertainment is a great write-off. And sure, it might have a little bit more of a risk of audit, but take it as a deduction because here in Southern California, the IRS expects you to entertain your clients. I have a quick example, just really quick. A buddy of mine that I graduated college with, he's in commercial real estate now. The year before he came to me, he was making about $60,000. He wrote off $20,000 in meals and entertainment, right, with this other agent in Orange County. And he comes to me and he says, listen, I'm making about double what I made last year. I have more deductions, and so I start to prepare his return, and even though his income doubled, he actually spent less in meals and entertainment. He only spent $13,000 that year entertaining his clients, made about $120,000 gross revenue, right? Guess what year he was questioned on?
The 13.
The one where he wrote off less meals and entertainment. Now, does that make sense? So I show up at the audit, and obviously I represent my client, so I show up at the audit, and the auditor says, you know, based on $120,000 of gross revenue, $13,000 isn't a reasonable amount. And I wanted to say, what rock are you living under? What rock are you? $13,000 is the bare minimum amount of entertainment for a young real estate agent to get his name out there. He's not 60, 70 years old with a Rolodex of 1,000 investors. He's a guy that's trying to make it in Southern California in one of the most competitive industries in the United States. He has to entertain his clients. So what I did was I walked the agent out to the front lawn of their commercial buildings, like a 50,000 square foot building, and I asked her, I said, how much do you think it costs to lease this building? And I made up some number. I said like, $30,000 a month or whatever. And I said, how much of a commission do you think these commercial agents make on leasing out this building? She said, well, I don't know. I said, on $30,000 a month, which is well over $300,000 a year in leasing this building, my agent, my client, makes about 3% and has to split the commissions with the other listing agents as well as CBRE, the company that he works for. And she said, wow, that really is crazy. And I said, do you think that if my client takes his client, his potential client, out to McDonald's and buys them a hamburger, and this client buys $50 million real estate investments, do you think that client's going to invest with my realtor? No. This guy is pitching his deals to people who buy 50, 60, 70, 100, $200 million properties. It's not going to take him to McDonald's. He's going to take him to Ruth Chris and spend $500 entertaining him and his wife and his children. And so it's going to be an expensive write-off. And it just happened to be, this was like perfect, this was like the nail in the coffin. There just happened to be a lease sign on the front lawn of their commercial building in Sherman Oaks, and the two listing agents on the property to lease out the rest of the office happened to be my client and his partner. Boom, she allowed the full deduction right there. So it was a success. It was a success story. Not all stories are that great, but man, it felt good to put that nail in the coffin, all right? Do not limit yourself on this write-off because there is an argument as to why it is an ordinary, necessary, legitimate, and above and beyond reasonable write-off, okay? Not the #1 most audited deduction, though, all right? So I went off on a little tangent there. We'll come back around. Depreciable equipment. I threw this up here because this happens to have one of the lowest risks for audit. And I just wanted to point that out. How many people own one of those things? I mean, that's a really old desktop computer, but how many people own at least one of these items? right? Everybody should be raising both hands and feet, all right? The iPhone, great deduction, it's a depreciable expense. It has lower than like a 0.1% chance for audit. Office furniture, desktop computers, the chairs, the printers, all of that stuff, it is necessary for doing business in the 21st century. I mean, if you don't have a cell phone, I don't know, once again, I don't know what rock you're living under, but if you have a pager, pagers are still around. I see people having pagers. Once again, depreciable expenses. Take these deductions 100%. It's called the Section 179 election. You want to make sure that you are not limiting these deductions. Take them in full. In the 9 going on 10 years I've worked for Robert Hall & Associates, I've never seen an audit on a cell phone purchase, on a computer purchase, on office furniture purchases, whether it's here at the office or in your in-home office. All right? So make sure that you take those full deductions. The number one most audited part of a self-employed real estate or real estate professional return, or realtor return, is the reporting of your gross income. Now, why do you think that is? Okay, sure, you could have all the deductions in the world, right? You could even be that person who spends all of their personal expenses and all of their business expenses out of one account, which is technically commingling, right? And you could be that person who takes every single deduction in the book, which probably isn't reasonable and legitimate and all that stuff, but you could be that taxpayer. But the number one thing that an agent looks for or asks for in an audit, the first thing they ask for is 12 months of bank statements, because they're looking for underreporting of income. That is the number one reason why people get nailed in an audit. It's because they deposit $500,000 into their bank account and they're only reporting $300,000 in gross revenue. Now there could be a million stories as to why that happened, right? I made $300,000 in commission income. One of my relatives passed away. I inherited $200,000. It went directly into my business account because that's where I needed the money. And all of a sudden I have a $500,000 gross deposit amount over 2014, right? And an agent audits me. They're going to want you to explain why you deposited $500,000 but only reported $300,000. So it's very important if you're inheriting money, if a relative is transferring money, if you have a loan out to a friend and they're paying you back, or if you have other hard money loans, that's a separate business from your real estate business, by the way, that you're depositing that into a separate account that is completely separate, maybe even a separate bank from your individual sole proprietor or corporate return as a real estate professional or realtor. Selling property for commission income, all right? That will be your best argument in an audit, is why you separated all of these sources of income, because you didn't want to commingle your income and expenses. And an agent will love you for that, okay? Because it's much easier to track expenses, it's much easier to legitimize things if it's all separated. If you have rental property, and you also sell property, do not deposit your rental income into the same bank account where your commission income is deposited. Separate it. Okay? Because at the end of the day, an agent is going to see you depositing all this money into that account, and they're going to expect that you're expensing things for both businesses out of that one account, and they're going to say commingling. They're going to make you hire a forensic bookkeeper, and you're going to pay thousands of dollars for a bookkeeper to go back over the last 2, 3, 4 years, however far they go back, and you're going to spend more money, more time organizing your information rather than just heading it off at the pass and taking care of it now. So gross income happens to be the first thing that an IRS agent verifies. Is incorporating right for you? Most of the people in the room here today are commission-based sales reps. I don't know if anybody else has W-2 income on the side, but most of you are self-employed realtors, okay? So you have this great opportunity that the Internal Revenue Service has put forward for the self-employed to incorporate. Now, for individuals in the room who are already LLCs or C Corps or S Corps, you're probably not going to benefit from a lot of what I'm talking about unless your accountant really isn't doing much with the incorporated entity. But I can tell you right now that out of the 3 types of entities that you have to choose from, the S Corp, the C Corp, and the LLC, the only entity that can actually save you tax, the only entity that can save you tax is the S Corporation. All right? The LLC and the C Corp are strictly for asset protection. The LLC is great, okay, if your net profit in your business, net profit, not gross revenue, but net profit is below $50,000. If you are that person who makes $150,000 in commission income, has very little overhead, maybe $50,000, and your profit that you're paying tax on is $100K, you're going to pay federal, state, and self-employment tax on the full $100,000 as a sole proprietor. You are a prime candidate for the S Corporation election. All right? If you're an LLC and all of a sudden you're thinking, man, this crazy guy is telling me that I need to be an S Corp, I need to shut down my LLC right now and switch it over to an S, don't shut it down. There's an election that you can make with the IRS that converts you for tax purposes from an LLC to an S Corp. And so therefore you can take care of or take advantage of all of the benefits of being an S Corp, all right? But is incorporating right for everybody? It absolutely is not. It is only right for the people who want to separate their real estate business from all of their personal assets, meaning the personal assets as your primary residence, your personal 401k, your retirement accounts, your spouse's investments, any inheritance income that you have, any transfers from outside of the country into your personal bank account here in the US. You want to separate your real estate business as much as possible. Sure, you have E&O insurance. Sure, you have liability insurance. Sure, you have malpractice insurance. You have all these insurance policies. But insurance policies do not separate personal from business assets. All that an insurance policy will do is pay out a settlement in case the unforeseen happens. So it's very important to have insurance, but it's also very important to diversify and separate your assets. So there are 3 questions that I ask every single client before I incorporate them. All right? One is, what do you own as personal assets? What do you own personally? If you tell me that you don't own anything, that you're new to the game, you don't own a home, you don't own a car, you don't have a 401k, you don't have inheritance, and you're not married, you don't have children, okay? Why would you incorporate? If I sue you, I'm going to try to squeeze juice from a turnip, right? I'm not going to get anything. But if you have the home, if you have equity, if you have paid off real estate investments, if you have a retirement account, if your spouse has investments, if you have hundreds of thousands of dollars in inheritance, right? You have personal assets that need to be protected. And the only way that you can do that is not through an insurance policy, not through a living trust. A living trust is important. We'll talk about that in a second. It is by incorporating your business and separating it completely from all of your personal assets. So I ask you what your personal assets are. The second question I ask is, what's going to be your projected net profit? So that I can calculate whether or not it makes sense financially to incorporate. Now, what calculation I'm making is for the S Corp people. It's not for the LLC people and the C Corp people, because those entities don't save you tax. But I need to calculate something. I need to make sure that it's going to save you more than it costs you to be an incorporated entity here in the state of California. Remember, we live in the highest tax state in the US, right? 13% is the highest tax rate here in the state of California. 13%. Federal is 39.6%. So if you're making good income and you're selling real estate left and right like hotcakes, right? You're making all this money, you're going to pay over 50% of your income in income tax, just federal and state. But then tack on that self-employment tax, that puts you well above 50% at like the 57, 58% bracket. That's not including your property taxes, your use tax, your sales tax, your LA City business tax. You're going to be paying well over 60% by the end of the day or by the end of the year, right? So you need to sit down and structure your business in a way that's going to save you exponential amounts of tax. The S Corp is the only way that you can do that. The third question that I ask my clients is, what kind of risk or liability do you operate at? I might incorporate you just because you have a high risk in your day-to-day operations, especially if you're like a contract attorney and you're drawing up really important contracts between certain parties, or if you're a contractor, you have huge liability as a contractor. You have liability as a realtor, but once again, you have insurance policies that protect you, so I'm more worried about protecting not your business, but your personal assets, separately from your business, all right? So very important questions for you to be asked. One question, well, this is the last slide, and I'm sorry I didn't throw up the calculation. I didn't want to make the calculation to show you how much an S corporation actually can save you, all right? On $100,000 of profit, we're going to use this for ease of calculation. On $100,000 of net profit as a self-employed individual, you're going to pay federal, state, and self-employment tax on $100,000 as a sole proprietor, non-incorporated entity, okay? That's 25% federal tax, that's 9.3% state, and that's 15.3% in self-employment tax. I see some heads shaking, and that's right. You should be mad. You should be pissed off that you're paying all this money in taxes, okay? But if you switch to an S corporation, you're not going to pay federal and state, or you're going to pay federal and state tax on the full $100,000, but what you're not going to pay on the full $100,000 is the self-employment tax. Because the S corporation follows something called a reasonable salary requirement, where you do not have to pay yourself 100% of your profit. The money is yours to take. You can take the full 100K out of your bank account anytime you want, but you do not take it as a salary. You pay yourself a minimum salary of 35%, which on $100,000 is $35,000. That's your W-2. And then on the $65,000 that's left over, you still pay federal and state tax, but guess what you don't pay? Self-employment tax, which is 15%, 15.3%. So take $65,000, multiply it by 15.3%, it comes out to about $9,975. Half of that is a tax write-off. So dollar for dollar tax savings just by being an S Corp versus a sole proprietor without you doing anything. The dollar for dollar savings is about $4,973 right out the gate. That's before playing the game of paying yourself to rent back your in-home office, which you're converting self-employed income to rental income now, saving even more tax. Then you get to deduct your mortgage, your property taxes, your homeowner's insurance, your HOA dues, which normally aren't a tax write-off against this rental income. All of a sudden, you have the potential to make $20,000 disappear, okay? I'm not telling you things that are illegal. This is what the Internal Revenue Code says that you can do. A corporation can have 1,000 offices across the globe, right? This is a benefit only for the self-employed incorporated entity, all right? And on top of that, you can do deferred compensation, put money into 401ks, profit-sharing plans, DB plans. You can save hundreds of thousands of dollars in unpaid tax, unnecessary tax. All right? If you're not doing that, you need to either contact myself or my associates at RHA. If you have an accountant that you've been with for however long and you trust him, maybe that accountant just isn't up to date with the benefits of incorporating. Or maybe your accountant doesn't know how to file an S corporation return. And so at that point, we can file your business return. You can stay with your accountant for the individual tax stuff, but bring your corporation to us. Let us help you save all of this money. Because remember, Uncle Sam's not going to knock on your door one day and say, hey, listen, I think you've been overpaying me. I just want to make sure that we're being fair here. So here's a check for all of those taxes that you overpaid. He's not going to do that. He will gladly accept your money, and he'll move on to the next year. So the thing that you have to do is in the current day, not in 2 years, 3 years, 4 years from now. You have to take action today.